Heaven help us. In this lesson of really hard accounting, we're tackling deferred income taxes, which is sometimes called future income taxes in other iterations of GAAP. The principles are the same. Few people seem to understand deferred income taxes, and I'm not only talking about students, I'm talking about professionals as well. But when you consider that on average that 30 to 40% of your bottom line is lost to income taxes, it's something that you better understand. So let's begin this lesson with a quick refresher. Deferred tax assets are good things. They imply that you have a tax pull that has not been fully reflected in the carrying value of the assets. The people who really want to make this confusing call these deductible temporary differences. I think of it just as an asset. And what gives rise to this asset? Well, think about situations where the accounting rules and the tax rules are different. How depreciation is calculated is one common difference. If the tax depreciation is slower than the accounting depreciation, then there's a lag in the deductibility of capital costs. You will get to deduct the differences, just not yet. Think of warranty expense. GAAP requires us to calculate a provision at the time that we sell our products to achieve appropriate matching. However, this expense is not deductible until we incur warranty costs. Thus, once again, we have a difference between the tax basis and the accounting basis of this item. There's no issue as to whether this item is deductible. It's simply a matter as to the timing of deductibility. This gives rise to either a deferred tax asset or a deferred tax liability. I always keep in my mind wind turbines as the poster child example to help me sort out whether I have an asset or a liability. The government loves to promote the construction of alternative energy sources, as is good for the environment and good for the economy. One way in which it has provided incentives in the past is to allow for what is called accelerated depreciation for tax purposes. This allows the wind developer to deduct the cost of constructing a wind turbine over a very short period of time, perhaps a few years. However, for accounting purposes, the wind turbines are still amortized over their economic lives, which is often 20 years or more. So you get the tax benefit up front in cash terms. However, there's an offsetting deferred tax liability that needs to be accounted for. Now, if this is the only wind turbine ever built by this developer, this liability will reverse in later years as the company has no more tax deductions to take against its income. Now, the GAAP gurus call these types of differences a taxable temporary difference. Now, you don't need to remember the terminology. You better well understand what sorts of situations represent a deferred tax asset and a deferred tax liability. Now, let's spin forward to the subject matter in this course, and that is business combinations. And so far, we've basically ignored income taxes at the date of acquisition. But rarely is that realistic. GAAP theory dictates that at the time we have any difference in our assets and liabilities between the accounting value and the tax value, we need to establish a deferred tax account for the difference. Note that we are only concerned with identifying taxable differences. Permanent differences do not get recorded. A permanent difference is one for an item that never gets deducted for tax purposes. Say, for example, goodwill in a share acquisition. Which brings up the point of this slide. As we learned way back in the second lesson, there are two basic ways to structure a business acquisition. Now, generally speaking, one of the advantages of an asset deal is that the price paid to acquire the assets becomes the tax basis for depreciation or deduction. In which case, there really is no tax basis differential to worry about. Now, God bless the asset deals in this situation. However, in a share deal, when the acquirer buys the shares of the company, and by the company I mean target company, the legal entity itself, it carries on as if nothing has happened. The tax basis of the net assets prior to the acquisition often carry on as the tax basis after acquisition. Now, this situation gives rise to taxable differences which can vary depending on the amount paid by the purchaser and the allocation of the purchase price across the asset classes. Where the tax basis of the net assets is lower than the purchase price, this will, generally speaking, give rise to a deferred tax liability. And when the tax basis is higher than the purchase price, this will, generally speaking, give rise to a deferred tax asset. And why is that? Well, in the case of a deferred tax liability, your accounting depreciation of assets will be higher than your tax depreciation. So if your net income before taxes was, say, $100, to calculate taxable income, you will need to add back the accounting depreciation of, say, $20 and subtract off the tax depreciation, which will be lower, say $15, giving you a taxable income of $105 and consequently a bigger tax bill. Each time you pay this bigger tax bill, you will draw down a portion of that deferred tax liability that you set up at the date of acquisition. Now, if you can follow that logic, you're in pretty good shape in terms of the expectations of this course. Unfortunately, in real life, you'll often hire tax specialists to help ferret out the taxable differences in a business combination, particularly in a share acquisition, as these can get a little bit complicated. For one reason, even though the legal entity carries on, tax rules often have special change of control provisions which can trigger certain deemed dispositions. I won't get into these rules in this course, so just be aware that you're getting kind of the 101 version of this particular subject. Let's see an example to consolidate our understanding. Here we have Target Company, and true to its name, Parent Corporation is interested in acquiring this company to add to its sprawling portfolio of diverse investments. The first column in this table indicates the book value of the net assets of Target Company. Note that Target Company already has $40,000 of deferred taxes set up in its assets section. Take a second and pause the lesson to think about what this amount means. You should realize that it arises from the fact that the tax basis of assets is higher than the accounting basis. The $40,000 is based on the taxable difference of $100, which is determined by the $900,000 tax basis less the $800 accounting basis. The bigger tax basis gives us higher tax deductions in the future, and thus we have an asset. Then Parent Corporation comes along and acquires Target Company shares for $1,100,000. Let's do the purchase price allocation calculation. First, we calculate the differential, and secondly, we need to allocate it. It's in the allocation that we now need to consider the deferred income taxes. The assets have fair value in excess of carrying value of $200,000 and in excess of the tax basis of $100,000. Aha! The accounting basis is now bigger than the tax basis. So we're going to have a deferred tax liability once Target Company is consolidated with Parent Corporation. So our purchase price allocation needs to adjust the deferred taxes to reflect the net liability of $40,000 instead of a net asset of $40,000, which means we have an $80,000 adjustment to make. And the residual left over goes to goodwill. Note that the goodwill does not factor into the calculation of deferred taxes. That's because it's a residual amount. Also, goodwill in a share acquisition is not deductible for tax purposes. So it would be one of those permanent differences I mentioned earlier. So let's do the consolidation so that you can see what the balance sheet would look like. For simplicity, we'll assume that Parent Corporation's sole raison d'etre, or the reason for being, is to hold the shares in Target Company. Target Company brings in their balance sheet, and then we will make our acquisition adjustments. The assets get adjusted to their fair values of $1 million. The deferred tax asset gets replaced with a deferred tax liability of $40,000, as we have just calculated. The investment gets eliminated, the goodwill gets set up, the liabilities are combined, and the shareholders' equity in Target's balance sheet get eliminated such that the parent shareholders' equity is all that matters. Capiche? Then there's one more wrinkle to consider before we end this lesson. Let's look at the same transaction again, only this time let's pretend that there's loss carry-forwards of $100,000 available in Target Company that have not been recorded in its records. When a company loses money for tax purposes, many taxing authorities allow the company to carry forward these losses and apply them against future taxable income to reduce their tax bill. So in a sense, tax losses are a kind of asset because they enable you to save taxes in the future. However, GAAP has specific rules to apply in determining whether a company can record these losses as an asset on the books of the company. Generally speaking, to get recorded as an asset, it must be probable that the company will have the ability to utilize these losses in the foreseeable future. Again, this is an area that can get quite complex because there are different types of losses, capital, non-capital, as well as the change of control provisions I mentioned earlier, which can vary by tax jurisdiction. But generally speaking, when a parent company acquires target company, these losses come along with the company. If parent company had instead bought the assets of target company and done an asset deal, these losses would not come along with the business. They would stay with the company. So the same deal as the last time. Parent corporation acquires all the shares of target company for $1,100,000. Let's do the purchase price allocation. The same acquisition differential of $560,000 arises on the transaction. The same assets and deferred income tax liability for the fair value increments is calculated. However, because of the acquisition by parent corporation, Target now has greater confidence that it will be able to utilize the losses it has incurred for tax purposes. This increase in the probability assessment means that a portion of the purchase price differential must be allocated to this deferred tax asset. $100 at the 40% expected statutory rate results in an allocation of $40,000. Consequently, our goodwill, the residual amount, is adjusted downwards by $40,000 to $400,000. Let's look at the balance sheet. Here we have the exact same balance sheet with one minor difference. We now have a deferred tax asset of $40,000 representing the loss carry forwards, and our goodwill is now $40,000 lower than we saw in the previous case. It may be uncertain at the date of acquisition as to whether the losses acquired will be realized or not. In the year immediately following an acquisition, any change to this assessment of the ultimate realization of these losses would result in an adjustment to the purchase price allocation. However, after the first year, any changes to this assessment would be reported through current year earnings. So there you have it, integrating income taxes into the business combination. At each reporting date in the years that follow, the consolidated entity will continually need to compare the book value of the assets and liabilities against the tax basis to determine the temporary differences which will cause deferred tax accounts to be adjusted accordingly. The offsetting entries will flow through current income tax expense. That's all for this lesson, so until next time, don't stop to get to the top. When you get to the top, don't stop.